All right, welcome back for another deep dive. Today, we're going to be looking at current market trends in India, and we've got a really fascinating source for this deep dive. It's this weekly newsletter from Volatilitygame, and it's dated November 16th, 2024. Now, a couple of things caught my eye right off the bat. First, a modified Buffett indicator that suggests a 5.6% yearly return for the Indian market. And this is really interesting. They even go so far as to give buy and sell recommendations that are actually tied to Rofa FT levels.
Yeah, that's what makes this newsletter so interesting, right? Because it's a little bit deeper. A lot of these things just give you like this very high-level market analysis, and they don't really give you any actionable insights. But this is like, almost a little peek into the playbook of a seasoned investor.
Yeah, exactly. It's like having a guide, right, to help you navigate the Indian market. And speaking of guidance, let's actually dive into that 5.6% projected return that they're talking about. They break it down like this. 7.19% economic growth, 0% dividend yield, and then this thing called valuation reverse to the mean at negative 1.56%. Now, what exactly does that last part mean for the average person, looking at the Indian market?
So essentially what it means is that, the market might be a little overvalued right now, and the valuation reverse to the mean, essentially that implies, is that things tend to balance out over time, right? So, that mega 1.56% is kind of hinting at a potential, a market correction that could be on the horizon, where, valuations come a little bit closer to their historical averages.
Okay, interesting. So while the projected return is positive, that valuation reverse to the mean, it kind of adds this little layer of complexity to it, right? It's not just like a straight upward trajectory.
Yeah. Exactly. It highlights that the market is a very dynamic thing. And it's also worth noting that they mentioned that the original Buffett indicator actually projected a 5.5% return.
Yeah.
And it had a slightly different breakdown. And this difference, I think, emphasizes how even like small adjustments to a financial model can actually really impact the outcome.
Right. So it's a good reminder to look at the big picture, right? And to not rely on just one single indicator. Speaking of looking at things differently, let's move on to those Nifty Y level recommendation that they talk about. So below 23,000 on the Nifty Y, they're suggesting that you convert your debt to equity. And then if it drops below 22,000, they're saying buy even more equity, even suggesting converting gold and fixed deposits.
Yeah, that's a bold approach, right?
Yeah.
It definitely points to an investor profile where, they're a little bit more comfortable with risk and potentially, higher rewards as well. But, converting assets like gold and fixed deposits into equity, that's a move that requires some careful consideration.
Yeah, it really makes you wonder who they're targeting with this newsletter, right? Because it seems like these are investors who are really comfortable with the ebbs and flows of the market and maybe have a longer term perspective.
I agree, yeah. The advice isn't necessarily bad, but it definitely emphasizes that, you need to know yourself. What's your risk tolerance? What are your financial goals? What's your investment timeline? And how comfortable are you with that volatility in the market? Because it is going to fluctuate.
That's a great point. You got to know yourself. And they go on to highlight large cap and momentum funds in particular, and specifically within banking, finance, IT, and pharma. Is there a reason why these sectors are emphasized, or is this just a coincidence?
So I don't think it's a coincidence, right? These sectors tend to drive a lot of growth, especially in emerging economies like India. So, you've got banking and finance, those fuel investment. IT is a major player in the innovation space. And then you've got pharma, which caters to a large and a growing population's healthcare needs.
So focusing on these sectors aligns with what we've seen so far, right? This higher risk, higher reward approach. It's about trying to capture some of that growth potential, but understanding that it comes with maybe a little bit greater volatility.
Precisely. Now, the newsletter also goes into this really, I think, fascinating timeline of market trends going all the way back to January of 2022.
Yeah.
And it's really interesting to see how sentiment has shifted over time.
Yeah, let's break those shifts down. So it starts with this negative trend in January of 22, has this brief positive jump in March, and then back to kind of like this negative or neutral territory, then shifts towards positive around May, and then it looks like it stayed relatively positive through August, and then that's when we see another dip back into the negative.
Yeah, and that volatility makes sense when you consider what was happening in 2022 globally, right? I mean, you had the war in Ukraine, you had rising inflation, supply chain disruptions, all of these things impacting markets worldwide, and India wasn't immune to those global pressures.
It's like this newsletter is almost it's like capturing those global influences and then providing this roadmap for navigating those resulting fluctuations in the market. And it really emphasizes that you need to kind of adapt your strategies based on these shifts, right?
Exactly, yeah. It's a much more dynamic approach to market analysis.
Uh,
They're particularly relevant when you're looking at emerging markets like India, because they tend to be much more susceptible to these global economic trends.
Now, moving on to November 17th, 2024, the newsletter provides a detailed breakdown of sector performance. Lots of numbers here, but what jumps out at me is the nifty small cap 100. Earlier, they labeled it positive, but it's actually showing a negative 0.81% change.
Yeah, and that just goes to show you the difference between short-term fluctuations and long-term trends. Even in a broadly positive sector, individual indices can experience these little dips, right? I mean, the market's a complex ecosystem, and daily news and events can impact things, on a smaller scale.
So positive in this case refers to the overall outlook, not necessarily a guarantee of like daily gains. And alongside those performance numbers, they also list PE, PB, and dividend yield. Can you just remind us why those metrics are so important when you're evaluating a company or a sector?
Absolutely. So the PE ratio, or price to earnings ratio, shows how much investors are willing to pay for each dollar of earnings. A high PE often signals high growth expectations, but it could also be a sign of overvaluation. The PB ratio, or price to book ratio, compares a company's market value to its book value, essentially its net assets. A low PB might suggest undervaluation, but it could also be a sign of financial distress. So again, context is key.
And lastly, we've got dividend yield, which shows how much dividend a company pays out relative to its share price. So that's a pretty good indicator of a company's financial stability and willingness to reward shareholders, right?
It is, but a high dividend yield alone doesn't tell the whole story. It's really crucial to consider the company's overall financial health and the consistency of those dividend payouts, because sometimes a really high yield might actually be masking some underlying issues.
Okay, so it's like having a financial toolbox, right? Each metric gives you a different piece of the puzzle, and understanding how to use them all together can help you make more informed investment decisions.
Precisely. It's not just about those individual components, but how they connect and influence each other.
Hmm.
And speaking of interconnectedness, this newsletter dives into something they call RVCC parameters, which stands for Rebalance Volatility Certification Course. It seems like a pretty specialized approach to market analysis.
It does. It's like this snapshot of, key market indicators at 2 points in time, November 17th, November 10th. And we've got PE, PB, MG, RSI, FI net open interest, Nifty levels, and VIX. So let's start with PE and PB since we just discussed those.
Yeah, so looking at those values from November 17th versus November 10th, that can actually show us how market valuations have shifted just over the past week. And we see a slight decrease in both. So PE has dropped from 22.27 to 21.65, and PD from 3.62 to 3.52. This could indicate that valuations are becoming more reasonable. Or it could just suggest a slight decrease in investor optimism about future growth.
Interesting. Now, MG is not one I'm super familiar with. What does that stand for?
MG likely refers to the market gauge. It combines several technical indicators to kind of provide a broad view of market sentiment. And the decrease that we're seeing from 105.65 to 103.1, that could suggest a shift towards more cautious or even bearish sentiment among investors.
Okay, so we're seeing some signs of potential caution creeping in. What about RSI?
So that's the Relative Strength Index. It's a momentum indicator. It essentially measures the magnitude of recent price changes. To help you evaluate overbought or oversold conditions, a reading above 70 is considered overbought, below 30 is considered oversold. In this case, the RSI has decreased from 50.08 to 46.87, still within a neutral range. But it could hint at a slight loss of momentum.
Okay. Now let's move on to FII net open interest. What insights can we gain from that?
Okay, so FII stands for Foreign Institutional Investors. And their net open interest refers to the total number of outstanding derivative contracts, like futures and options, that are held by these investors. It's essentially an indicator of their overall activity and sentiment. And we're seeing an increase from 2.36 lakh to 1.42 lakh. Now, this doesn't necessarily mean that foreign investment is pouring in, because an increase in net open interest can actually reflect either buying or selling activity. So we need a little more context to really interpret this change accurately.
Okay, so not a super clear signal one way or another about foreign investment. What about Nifty levels? The newsletter mentioned, 23,000 and 22,000 as kind of key thresholds for different strategies. And right now, the Nifty is sitting at 23,532 0.7 to 0.
Right. So according to the newsletter, we're currently in that zone where converting debt to equity is advisable. But it's important to remember that those thresholds are dynamic, right? They adjust to the market's movements. It's not about rigidly sticking to these numbers, but understanding the logic behind those recommendations and adapting to the current market situation.
Right, right. And finally, we have the VIX, the Volatility Index, also known as the fear gauge. It basically measures market expectations of volatility over the next 30 days. And generally speaking, a higher VIX means there's more uncertainty and fear in the market.
Right. And here we're actually seeing something pretty interesting. The VIX has actually decreased from 14.47 to 14.78. So despite the potential caution that we saw in some of the other indicators, the overall market volatility expectations have actually remained relatively stable.
So it seems like we're getting kind of mixed signals here. Some things are pointing toward potential caution, while others are suggesting continued stability.
Exactly. And this is really where the true art of market analysis comes in.
Yeah.
Weighing the different pieces of evidence, considering the broader economic and geopolitical context, and forming your own informed conclusions.
It's a good reminder that market analysis isn't a perfect science, right? It's more of a process of continuous learning, adaptation, and making informed decisions.
Absolutely. And I think this newsletter, with all of its data and insights, provides a really valuable framework for navigating the complexities of the Indian stock market.
Yeah, it's like we're putting together this giant market puzzle, right? Using all these different indicators and insights to try to get like a clearer picture of what's going on in India.
That's a great analogy. And it's important to remember this newsletter is just, one piece of that puzzle. It's always a good idea to, do your own research, consult with financial advisors, and just stay updated on market developments before, making any investment decisions.
Absolutely. It's about being informed, not just blindly following recommendations, right? Before we wrap up, I wanted to touch on the notes and observations section briefly. They mention that the lower the Nifty goes, the more you should convert FlexiCap to multi-cap funds. Why the emphasis on multi-cap funds in a downturn?
So multi-cap funds offer diversification across different market capitalizations, meaning they invest in large, mid, and small cap companies. And this diversification can help potentially reduce risk during volatile market conditions, which is especially relevant in a downturn.
So it's kind of like spreading your bets a little bit,
yeah,
and potentially mitigating some losses if one particular market segment underperforms.
Exactly. It's a risk management strategy that's often employed during times of uncertainty.
Makes sense. The newsletter also emphasizes a focus on large cap and momentum funds right now. Does that align with their overall strategy of, kind of seeking those potentially higher returns, even with maybe higher risk involved?
Yeah, I think so. Large cap funds, those typically invest in well-established companies, with a history of kind of stable performance. While they might not, offer the same explosive growth potential as some small cap companies, they tend to be, less volatile. And they can provide like a solid foundation for a portfolio, especially, during times of uncertainty.
Okay. And what about momentum funds? What's the thinking there?
So momentum funds, those invest in stocks that have shown, really strong recent price performance. They're basically riding the wave of those upward trends. And the strategy can generate some, pretty high returns in a bullish market, but it also carries the risk of, some pretty sharp declines if that momentum reverses.
Right. So it's a little bit of a double-edged sword. High potential rewards, but also higher potential risks.
Precisely.
Yeah.
It's a strategy that definitely aligns with, the newsletter's overall theme of seeking those potentially higher returns, but also, acknowledging the inherent volatility of the market.
So as we wrap up our deep dive into this fascinating newsletter, what would you say are the key takeaways for our listeners?
I think the key takeaways are that, the Indian stock market is projected to yield a pretty decent return, 5.6% annually, according to that modified Buffett indicator, driven by economic growth and tempered slightly by some potential valuation adjustments. I think it's also important to remember that investment strategies really need to be tailored to individual risk tolerance, especially, given those very specific recommendations related to NIFWE levels. And finally, understanding those market indicators that we talked about, like PE, PBMG, RSI, VIX, those are crucial for really interpreting market trends and ultimately making those informed investment decisions.
That's a great summary. This has been a really insightful journey into the Indian market landscape. And as a final thought for our listeners, given all this information, how would you approach investing in the Indian market right now? Would you be, drawn to the high growth potential of certain sectors, or would you maybe prioritize a more conservative and diversified approach? There's really no right or wrong answer here. It's all about finding that strategy that aligns with your financial goals and your risk tolerance.
And remember, it's always wise to, seek advice from a qualified financial advisor before making any significant investment decisions. They can provide, personalized guidance based on your specific circumstances and really help you navigate those complexities of the market.
I couldn't agree more. Well, there you have it, folks. Another deep dive into the Indian stock market, guided by this insightful newsletter. We hope you found it informative and empowering. Until next time, happy investing.